Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Fed officials open to a big move. Goldman forecasting yield curve inversion as Citi predicts 4 half-point hikes. We begin with the big issue. 50 is the new 25.
Citi just told my market to hold my beer and watch this.
They go 50 in May. That's the new hike.
I don't see what the argument is to not go 50 again in June, to not go 50 again in July, to not go 50 again in September.
They're going to keep going 50 and 50.
They're going to do 50 basis points. Why wouldn't they?
This is inflation that's around 8% and set to pick up closer to 9%.
Inflation is going to be absolutely insane for March.
The average consumer right now is losing ground.
40% of the American public has less than $1,000 of savings and they rent. They're getting killed by inflation.
There is a huge question mark over how the household sector responds to the surge in food and energy prices.
Call me when we get to 3% in inflation and then they'll stop.
This is really a Fed now that is in inflation fighting mode.
I think it's going to be a wild ride.
Joining us now is Goldman's Amanda Lyam, Invesco's Rob Waldner, and Academy's Peter Tchir. So let's talk about the monster call. It's from Citi, and it sounds a little like this. We now expect the Fed to raise rates 275 basis points in 2022. They're looking for a 50 basis point move at each and every meeting from May, June, July, and through September as well. Amanda, first to you, just your reaction. We'll go one by one here to this call, Amanda, from Citi.
So, I mean, I think it's indicative of the complete volatility that we've seen in the market over the past few weeks. Even, as you know, our own economists are expecting 2 50 basis point hikes in May and then in June, and then 4 25 basis point hikes this year, and then 3 more next year, all up to a terminal rate of 3 to 3 1/4. So things are moving quickly. It's been very volatile. It's been very facts changing. I think, us and our colleagues are responding to the Fed commentary that's been out there that's been really focused on the inflationary backdrop.
Bit of cheer. Can we take it this far?
That seems extreme. I think they're setting us up for 50 at the next meeting. But this was a Fed that should have been probably cutting the balance sheet purchases a year ago, and they didn't stop until they finally had to. They could have done 50 at this meeting. They only did 25. So I think they're setting us up for 50 next meeting, but I think it's going to be data dependent, and they may be so far behind the curve, they actually missed the curve. So I don't think we're going to get anywhere close to that number of hikes.
The Citi thinks they'll be data dependent too. They just have a different view on the data. I caught up with Andrew Hollenhorst a little bit earlier this morning. Take a listen.
When you're in inflation fighting mode, you need to get rates to a level that actually provides some restraint on the economy. So I think that's kind of the big picture, what's behind the change in the forecast, what's behind the change in the rhetoric from the Fed. It's the need for the Fed to bring inflation down.
Rob Waldner, what is restrictive? What level of rates would be restrictive from your perspective?
Well, I think we need to get well above neutral. And, the key to understanding what the market's doing here is that the market's finally listening to Chair Powell. And the real value recently from the Fed has been in these press conferences where he's first set us up to tell us we're behind. And then at the end of the last press conference, he said he wants to get to neutral as soon as practically possible. And if you think about what that means they want to get, above 2 very soon. So, I think that's what the market is coming close to pricing in here, would be getting above 2 in the third quarter. And then I think, you need to, depending on the inflation path in the second half of the year, will really determine what is whether they need to go restrictive, which is exactly what he said, of course, too, in that same press conference.
Rob, just to be clear here, you think 2% is neutral? Do you think that starts to restrict the economy once you go over 2%?
I think about 2 1/4 is probably a good guess for what neutral is. That's the same level as what we think potential growth is roughly in the U.S.
What convinces you of that, given where inflation is at the moment?
Well, so inflation will peak out and come down over the balance of this year. I think we'll end up with inflation lower than we started just because of those transitory components. So you kind of need to look through the short-term headline. I'm not saying that inflation is going to not be a problem this year. It'll end up still well above the Fed's targets. But you have to look through the near-term inflation to get a more longer-term neutral.
The last time we did this, the market told Chairman Powell where neutral was. He thought it was somewhere else. And then everything started to seize up, and then they stopped and had to back away. Amanda, where do you think policy becomes restrictive? We're talking about massive moves now in the Fed funds rate, together with significant balance sheet reduction as well. Where do you think that restrictive stance starts to kick in?
Right. I mean, I think we have a long way to go. Our economists don't view it as mutually exclusive, for example, to announce the balance sheet reduction in May alongside a 50 basis point hike. I think, a terminal rate of 3 and 3 1/4 over the long run. Our economists have said something similar, around 2 1/4 for kind of a long-term rate. Not that that's necessarily restrictive, but I think there's a lot of policy tightening between now and then in order to get inflation under control, and our rate strategists expect the Fed to remain in restrictive policy and rate hiking mode for the next few years.
Do you see the market pushing back anytime soon, Amanda? Just looking at how credit's trading, how equities are trading too.
Yeah, credit's been really resilient. We think part of that is this backdrop. While nominal rates have repriced very swiftly, you've also had this backdrop of break-even inflation going higher alongside real yields. And so what our rate strategists, for example, have really emphasized is that it's not so much the inversion in the nominal yield curve that should be concerning in terms of signaling recession risk, but it's really watching that real yield curve. And that real yield curve remains upward sloping because the inflation curve is still inverted. So I think that's allowed credit spreads to digest this in a fairly resilient way. As you know, I mean, the high yield index is still well below 400 basis points. IG is hovering around 120. And so that's not really indicative in any way of recession risk. I think the market understands that the Fed needs to get inflation under control.
Pete, this is a massive move in the bond market today, up 17 basis points at the front end through 230 on twos. Earlier this month, the first trading day of March, we were down in the 120s. In the middle of the session. Now we're in the 230s. That's a massive move. And then, Pete, I'll go one step further and look at the equity market this month. The S&P's up more than 3%. Can you reconcile that, Pete? And does that tell you something about the work this Fed needs to do? And I wonder if that's what's changed for the Fed in the past week. They looked at the reaction to the move on Wednesday when Chairman Powell conducted that news conference, looked at the market and realized that financial conditions didn't tighten. They loosened. They've got work to do. Do you agree?
Yeah, I think they've got work to do. Part of this, though, is, the equity markets both markets really have been beating to two drums, right? You have the Fed and what the Fed's trying to do, and then you have this war in Russia and Ukraine and what that is doing to markets. So I think equities had a good reason to bounce from that. I think the one thing we haven't focused on enough is everyone's talked about the rate hikes. Powell even hinted that the minutes would contain some good information on what the balance sheet reduction is going to look like. I think the balance sheet reduction is actually going to have a more of an impact on risk assets than even the hikes. I think the hikes will be telegraphed. They're going to be gradual. They'll be data dependent. But once he starts on this balance sheet reduction, that could be the surprise. And I think that's going to impact all risk assets.
Curve inversion
negatively.
Potentially as well. I want to talk about that too. 2s, 10s down to 18. Goldman came out earlier this week, in the last 24 hours actually, took their 2-year forecast to 290, their 10-year forecast to 270. You can do the maths. That's curve inversion year end. Then next year, curve inversion again. The year after, curve inversion again. Now, Amanda, I hate to put you in competition against your rate strategist, but help me understand all this, because we've got curve inversion year end for 22 at Goldman, 23 at Goldman, 24 at Goldman. What does that mean for credit? And how unprecedented would it be to have credit resilient in the face of all of that?
Yeah. So the reasoning for the curve inversion for the next 2-3 years is really that our rate strategists are expecting monetary policy and the Fed to remain in restrictive territory. And so that's what that is reflecting, that policy rate moving at the front end of the curve, but then kind of the liability driven investing at the longer end of the curve, keeping those yields, especially at the 30-year point, relatively sticky, but also at the 10-year point. I think for credit in particular, look, one of the key fundamental anchors that we've had throughout this period of volatility and this kind of fast moving backdrop has been the exceptional amount of liquidity that's remained on corporate balance sheets. And we've seen credit metrics improve substantially over the past 2 years. And while we do think that the peak in credit quality is likely behind us at this point, we're unquestionably entering this period from a position of strength. If you look at leverage metrics, coverage metrics, cash on hand, cash to assets, they all tell a very similar story. see that credit metrics are the strongest of the post-financial crisis period. So I think a large part of this will be determined by corporate capital management philosophies and whether or not they are appropriately conservative if we are entering a period of much slower growth. I think part of it will be able, will tell how these companies are dealing with margin headwinds. And then, of course, if we enter a recession, that slower growth backdrop is a real risk for credit, especially if it is coupled with persistently high inflation or a stagflationary environment. Credit does not respond well to that. But in the near term, you might have seen that we do still expect defaults for 2022 to remain pretty low and benign, largely driven by that liquidity position that I mentioned.
One of the reasons that maybe Peter Tchir is starting to like high yield as well. I'm going to return to that story in just a moment. Peter Tchir, Rob Waldner, Amanda Lyam. Coming up on this programme, up next, the auction blog, companies flocking to the investment grade market at a near record pace. That conversation coming up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe with the primary market smashing weekly estimates. Offerings from L'Oreal and Nestle helping fuel the second busiest week of the year. US investment-grade bond sales nearing $200 billion in March, closing in on one of the busiest months on record. And the US junk bond market recording its slowest month in 2 years. Borrowers remaining on the sidelines amid rising inflation concerns. On inflation, stagflation, recession and depression, take a listen to what Mohamed Al-Arian had to say this week.
We're going to see a global stagflation. We're going to see depression in Russia and Ukraine. We're going to see a recession in Europe. We're going to see stagflation in the US. And we're going to see a number of commodity importing developing countries running into debt problems.
Back with us, Amanda Lyam, Rob Waldner and Peter Tchir. Amanda, let's go through that piece by piece before we run away and hide under a rock. A depression in Russia and Ukraine, recession in Europe, stagflation in the US, and massive debt problems in emerging markets. Can you run me through your US-Europe call, Amanda, and apply that to how you're thinking about credit at the moment? Could we really get that kind of economic dynamic, that backdrop that drives things?
So that is not our base case. Our economists, for context, are expecting 3% real GDP growth in 2022 in the US, 2.5% in the euro area. I think the difference that we've held across geographies is that the euro area, in our view, is more exposed and more vulnerable to the risks related to the Ukraine-Russia war and the geopolitical tensions that could weigh on growth because of some of the considerations of Europe, like the dependency on certain commodities. And so the preference from our side on the corporate credit market is to prefer US spreads over the European peers. But while our economists are expecting a growth slowdown, they are not expecting the kind of environment that is stagflationary or recessionary, at least not at this juncture.
Rob Waldner, your take, your reaction to that.
Yeah, I would agree with Amanda that we're not expecting a recession, we're not expecting stagflation. What we have is just incredibly strong top line growth in the U.S. We're going to have nominal GDP here growing in double digits. And that's just very supportive for credit overall. So I see that as with negative real yields and double-digit top-line growth, it's a pretty from a fundamental perspective, it's supportive for credit. You highlighted in the intro here, there are a lot of technical headwinds, outflows, 11 weeks outflows in high yield, for instance, that are causing volatility, but the fundamentals are very positive.
Peter Tchir, what do you think?
Yeah, I think we are going to see a bit of a recession in Europe. So that part I agree. I think they're going to be hit harder by second-order effects. We're going to see supply chain issues creep up all over the place in Europe due to what's going on with Russia and Ukraine. I think we'll be a little bit more immune from that. So I don't think we see stagflation. I think we see continued inflation, but that's part of our growth strategy, right? As we redeploy capital to reinvest in energy infrastructure, as we rush to get more sustainable energy things. So I think we're going to see a lot of spending and growth here. So it's going to be inflationary, but we are going to have the growth to match that. So it's not going to be the stagflation environment in the US.
To what extent have we priced the recession that you're calling for in Europe, Pete? Do you think we've done that?
I don't think so yet. I think we are really waiting to see. And when I watch the headline reaction, I think we're very optimistic. Every time something comes out about peace or possible peace, we react very strongly. Anytime another warning comes out, whether from the administration about weapons of mass destruction or something like that, we seem to shrug it off. And yet they did go and invade. They've taken step after step that we never thought possible collectively. So I don't think it's priced in Europe right now.
Pete, I know you're starting to like high yield, and you're not alone. Bob Michael of JP Morgan Asset Management had this to say. Here's the quote. "We seem to have got a year of repricing in just a few months. Simply put, current valuations were too compelling to ignore. There's still reasonable risk, but it feels as though a lot is already in the price." Do you agree with that statement on credit in America, Peter Tchir?
I do. I think one thing is on high yield, right? It's an all-in yield. So spreads aren't super wide, but all-in yields are the most attractive they've been in a while. The companies are generally a little bit more domestic focused. There is still a strong energy component. So I think there's a lot of opportunity for this industry to do very, high yield to do very well. You're going to see some real performance within the subsectors. I like it. I don't think you're going to see a ton of issuance. We may see some M&A activity again picking up as investment grade companies look to purchase high yield companies again. So I'm constructive right now, and so much is built in. And I think what people forget is at 6-7% even, you are getting paid to wait, right? So a lack of defaults is a good thing even. So you don't need a big rally from here just to get that carry. So I think it's going to do well.
Amanda, Pete was alluding to that corporate discipline that you highlighted in the previous segment. Why do you believe that's something that might stick?
Well, I think if you listen to what a lot of the largest issuers in the high yield market are signaling, it's that they're still focused on maintaining balance sheet strength and in some instances moving back into IG territory. And so we've held the view for a long time that really the most opportunity for balance sheet deterioration is probably at the high end of the investment grade spectrum, not necessarily in the high yield market. I will say last night we downgraded our overweight allocation on high yield to kind of a slight overweight versus IG instead of kind of just a regular overweight. We are getting a little bit concerned about downside risks to growth and investors focusing more on quality. I mentioned that the peak in credit quality is likely behind us. Again, not expecting a material uptick in defaults by any stretch. And I do think that the conservative capital management for high yield will serve as a tailwind. But I think the case for strong compression, so strong outperformance of high yield versus IG is a bit limited from here. I will also say, though, on the positive side, the high yield market has held in well in terms of performance despite 11 straight weeks of outflows from mutual funds and ETFs. I think that further underscores that fund flows in and of themselves are not a strong driver of performance, but that has been quite remarkable to watch, probably bolstered in part by the light supply backdrop that you mentioned, Jonathan.
Amanda, when you think about previous cycles and the peak in credit quality, what typically happens? What does performance look like in the 12, 18 months after that?
Yeah, I mean, it really is, it depends. I mean, from the period in late 2018, there was a lot of focus on kind of late cycle releveraging risks and large scale M&A, debt funded M&A for that part. I think a big part of it matters on how a lot of the activity on terms of the M&A or LBO side is funded for 2020 and 2021. That was pretty conservative. So we actually saw leverage metrics for LBOs decline. We saw a large amount of M&A funded with equity. That's shifting a bit for 2022. And so I think the fundamental reaction is it tends to be, somewhat volatile in the sense that if companies are acquiring for growth, that could actually be a good thing. If they're doing M&A and it's funded with equity, that could be a positive, but it will really depend on what the capital management mindset is. I think investors are smart in the sense that they often price rating agency actions ahead of time. They often price fundamental deterioration ahead of time because there is a strong signaling effect that you can pick up on just by following companies closely. So I think, in my view, performance will tend to lead any sort of fundamental metrics that will likely come on a delay.
Rob Waldner, you get the final word. Do you agree?
I guess I'm a little bit less positive on high fundamental strength there, but I expect we'll continue to get headwinds that'll keep volatility there. I actually might think more about emerging markets where, I think there's been a big perspective, and if you look over a 10-year history, high yield doesn't look particularly
your connection is going back and forth just a little bit in my ear. Anyway, you agree to some degree, to some extent, and we can come back and you can tell me if you really disagree with my characterization of whether you agree or not. Rob Waldner, Amanda Lyam, Peter Tchir, sticking with us. Coming up, still ahead the final spread, the week ahead, featuring the payrolls report. It's that soon, really? Next week, next Friday, payrolls just around the corner. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up over the next week, the President of the United States releasing his 2023 budget on Monday, plus Fed speak from Harker, Bostic, Williams and Barkin, all on the calendar. A busy week of US economic data as well, consumer confidence, US GDP and another inflation print. And finally closing out the week with the payrolls report just around the corner on Friday. Your estimates so far, 480,000. The previous read, 678. Back with us, Amanda Lyam, Rob Waldner and Peter Tchir. Pete, first to you, just quickly, just on the data next week. We've seen consumer confidence, that data in America, sentiment from you, Mitch, it's terrible. It's at decade lows. And when you read the survey, it's terrible too. At what point does that start to damage output, Pete? Are you seeing any sign of that whatsoever?
Yeah, I've been looking at housing, right? You've seen housing roll over a little bit. The last little bit of economic data on the housing front has been weak. You see mortgage rates at multi-year highs. So I think we could be turning over. And that's why I'm really concerned that we've missed the curve entirely. And we're starting to see some things that are going to weigh on growth, weigh on inflation. And all we're talking about is inflation.
And yet you're interested in high yield. Maybe that's the question for another time. Should we get to the rapid fire round? 3 quick questions, 3 quick answers. And I'll start with this. How much tightening this year in basis points? How much tightening this year from this Federal Reserve in basis points? Peter Tchir.
I'll go with 75 more.
75 more this year. Rob Waldner.
I think we are going to see a lot of problems out of Europe.
Rob Waldner.
We get 2% more in rate hikes.
Amanda Lyam.
2% as well, more.
When does the Fed funds peak? With a 1 handle, a 2 handle, a 3 or a 4? Pick one. Rob Waldner.
2 handle.
Peter Tchir.
1 handle.
Amanda Lyam.
3.
Here's the tough one. Pick a year for the first rate cut. Pick a year for the first rate cut. Amanda.
Oh, man. Let's say 2027.
27. Peter Tchir.
2023.
Amanda Lyam has done 2027. We've got something around 23. Rob Waldner, final word.
2024.
There we go. Amanda Lyam, Rob Waldner, Peter Tchir, thank you. This was Bloomberg Real Yield. This is Bloomberg TV.